All right, let's talk about something every global investor thinks about, but maybe doesn't love talking about: US taxes. If you're earning income from property in the States, you're going to want to stick around. We're going to break it all down and show you how to handle it like a pro.
Oh, you know that feeling, right? You've just made your first investment in a US property. That email lands in your inbox, your dividend has arrived. It's exhilarating. But then, like 5 seconds later, another thought pops into your head. Oh, wait, what about taxes?
And suddenly it's not just one question, is it? It's a whole flood of them. Do I have to pay taxes in the US? And in my home country too? Am I going to get double taxed? Is this going to be a huge, complicated mess? Look, these are the big questions that every single global investor has.
So, let's dive into this moment. We can call it the investor's tax awakening. And I know it can feel a little daunting, but I want you to try and shift your perspective here. Don't think of it as a penalty. Think of it as the cost of doing business, the price of legitimacy. It's actually proof that you're playing in the big leagues, that your investment is real and fully regulated.
Okay, first things first, let's get on the same page about what we're talking about here: fractional ownership. It's not the same as just buying a stock. With this model, you're actually co-owning a real physical piece of property. You're buying shares in a legal entity, usually an LLC, that holds the deed to that building. It means you have direct exposure to a tangible asset.
And this is a really, really important distinction to make. This is not a REIT, a real estate investment trust. Those are traded like stocks and have a whole different set of tax regulations. Fractional ownership, on the other hand, is governed by plain old real estate tax rules. And that one single difference, it changes the entire game when it comes to taxes.
Okay, so you might be thinking, if I'm being taxed in a country that's not my own, how am I protected? And that's the right question to ask. The great news is there's already this really solid international safety net built for exactly this situation. Here's how it works. There are two places involved, right? The US, where the money is made, that's the source, and your home country, where you live, that's your residence. Now, to prevent total chaos and you getting taxed into oblivion, most countries have signed what are called double taxation avoidance agreements, or DTAAs, with the United States. And their one job, their entire purpose, is to make sure you don't get taxed twice on the same exact income.
So, what does this actually look like day to day? Well, it's really just a simple two-stage process. Seriously, once you see it, you'll realize it's not nearly as scary as it sounds.
Think of it like a relay race. First, the US takes its turn. The income gets taxed right there at the source by the IRS before it even gets to you. Then the baton is passed. When you file your taxes back home, you report that income, but you also say, hey, I already paid taxes on this in the US, and you get a credit for it. Simple as that.
Let's zoom in on stage one, the US side. So a chunk of your gross rental income, typically somewhere between 20 and 30%, is held back for the IRS. But, and this is so important, that's on the gross income. Your real taxable income gets to be smaller because you can deduct all sorts of expenses, things like maintenance, mortgage interest, and the big one, depreciation. This can slash your taxable income and bring your effective tax rate way down. And don't worry, you'll get an official form, something like a 1099 or a K-1, that spells all of this out so you.
Okay, if there is one thing you take away from all of this, let it be this mantra: you report twice, but you pay once. Say it with me: report twice, pay once. That's it. That's the core principle. It's the whole foundation of the system that protects global investors from double taxation.
All right, theory is one thing, but let's see how this plays out with some actual numbers. This is where you can really see how this whole foreign tax credit thing actually boosts your bottom line.
Okay, let's walk through this. Let's say you put in $10,000 and the property has a 7% yield. That gives you $700 in gross income for the year. The US withholds its 20%, which is $140, so $560 lands in your account. Now, let's say your tax rate back home is 25%. A 25% tax on that $700 would be $175. But remember, you already paid $140 in the US, so you only owe the difference, which is just $35 to your home country. And check this out. This is the magic right here. Even though your home country's tax rate is 25%, your actual effective global tax rate on that income ends up being only 17.5%. That's the foreign tax credit doing its job. See, it's not just about following the rules. It's a tool that can literally make your investment more profitable. And listen, this isn't just some made-up example. We see this all the time. Take Maria, an investor from Madrid. She put in $25,000. And after the whole system did its thing, US withholding, getting the credit back in Spain, her final take-home yield was over 6.4%. That's a fantastic, totally passive return, and it's all thanks to the system working exactly as it should.
This is exactly why smart money from around the world is pouring into U.S. real estate. Just look at the numbers. Last year, we saw $92 billion in income reported from foreign-owned properties. That's a huge 14% jump from the year before. Why? Because savvy investors have realized that this tax system isn't a problem to be solved, it's a feature. It provides clarity and stability.
Okay, so now that we get the basics, let's talk about leveling up. Because the best investors don't just follow the rules, they use the rules to their advantage. We're going to shift from just being compliant to being truly strategic. A really strategic approach boils down to 3 key things. Number 1, smart structuring. You want to use something like a US LLC so the taxes and all those great deductions flow right through to you. Number 2, automated compliance. You should be using a platform that just handles this stuff, automatically generating the tax forms you need. And third, cross-border support. Having help to make sure your US documents play nice with your filings back home is a game changer.
And here's a little pro tip for when you eventually sell the property. Even the profit you make, the capital gains, can be managed strategically. There's this amazing tool in the U.S. tax code called a 1031 exchange. It basically lets you take all the money from a sale and roll it directly into a new property, deferring the capital gains tax. It's an incredibly powerful way to keep your money working for you and compounding over time.
So let's wrap this up by taking a step back. Because what we've been talking about, it's more than just a technical process. It's really about adopting a whole new mindset, the mindset of a true global investor, building long-term, lasting wealth. From now on, when you see that tax withheld line item on your statement, I want you to see it differently. Don't see it as money you've lost. See it as a badge of honor. It's the evidence of legitimacy. It's the proof that you own a real asset inside a transparent, regulated system that is, believe it or not, designed to protect you. And that really gets to the heart of what it means to be a serious global investor. The goal isn't just to find tricky ways to avoid taxes. No way. The real goal is to build a portfolio so successful that it generates significant, stable, dollar-denominated income that is worth taxing. That is how you build real, generational wealth.